Picture this, you're at the gas pump, wincing as the price ticks higher. Your grocery bill's up too, and your savings aren't stretching like they used to. Why? A tense standoff between Israel and Iran is shaking the world economy, and your wallet's caught in the crossfire. Reuters reports Israel struck Iranian military targets on June 13, 2025, sparking fears of a wider conflict. Iran's threats of retaliation per Bloomberg have markets on edge. This isn't just a far-off crisis, it's hitting you where it hurts. Why does this matter? Because this clash is driving up oil prices fast. Brent crude hit $78 a barrel last week, a 13% jump per Bloomberg. By June 16th, it eased to $74, still $10 pricier than last month. Oil's not just gas, it's the backbone of shipping, groceries, even your power bill. That extra $5 at the pump or $10 at the store, that's this conflict at work. Wall Street's rattled too. The New York Times says the S&P 500 dropped 1.1% Friday as investors braced for trouble. Defense stocks climbed, but airlines and retailers took a hit. The US is tangled in this. $3.8 billion in annual aid to Israel, per the State Department, and a $1.9 trillion deficit, says the Treasury. If oil hits $90, as Goldman Sachs warns, inflation could spike 1% per Capital Economics, hiking everything from coffee to mortgages. Your paycheck, your plans, they're at risk. Stay with us. We'll break down how this could spiral and what you can do to fight back. Why should you care? Because this conflict is jacking up oil prices, and when oil prices spike, everything else follows. On Friday, Brent crude, the global oil benchmark, jumped to $78 a barrel, a 13% surge in just a week, per the Australian Financial Review. By Monday, June 16th, prices cooled slightly to around $74, but that's still $10 higher than last month. Why does this matter to you? Because oil isn't just about gas for your car. It's the lifeblood of the global economy. Higher oil prices mean pricier shipping, more expensive groceries, and bigger utility bills. If you've noticed a few extra bucks disappearing at the pump or the store, this is why. And it's not just about oil. This conflict is rattling Wall Street. On Friday, the S&P 500 dropped 1.1%, according to the New York Times, as investors panicked over the uncertainty. Defense stocks soared, but airlines and other industries took a hit as fuel costs climbed. By Monday, markets bounced back a bit. CNBC reported the Dow gained 248 points because some investors bet the conflict won't spiral out of control. But don't get too comfortable. RBC Capital Markets warns that if this drags on, the S&P 500 could plunge as much as 20%. That's your 401k, your pension, your savings, potentially taking a massive hit. Here's the kicker. The US is deeply tied to this mess. The Biden administration has pledged billions in military aid to Israel, with $3.8 billion already allocated annually. According to 2023 data, every missile, every jet, every troop deployment costs money, your tax dollars. And with the US budget deficit already at $1.9 trillion in 2024, piling on more spending could push us closer to a fiscal cliff. So what's driving this economic chaos? It's the fear of disruption in the Middle East, where a third of the world's oil flows through the Strait of Hormuz. Iran's threats to close this choke point, even if unlikely, are enough to make markets nervous. Goldman Sachs estimates that a prolonged disruption could slash Iranian oil exports by 1.75 million barrels a day, spiking prices further. And if oil hits $100 a barrel, as some analysts fear, Capital Economics says that could add 1% to inflation in advanced economies like ours. That means everything from your morning coffee to your mortgage payment gets pricier. Look, I'm not here to scare you, but to give it to you straight. This conflict isn't just about geopolitics. It's about your paycheck, your bills, and your future. In the coming parts, we'll dive deeper into how this could reshape inflation, what it means for your investments, and what you can do to protect yourself. But for now, know this. The Israel-Iran conflict is already hitting us where it hurts, and if it escalates, the hidden costs could change the way we all live. All right, folks, let's pick up where we left off. The Israel-Iran conflict is sending shockwaves through the global economy, and the US is right in the crosshairs. In part 1, we talked about skyrocketing oil prices, jittery stock markets, and the tax dollars fueling this fight. Now, let's dig into the next big threat, inflation. It's not just a buzzword, it's the silent thief that could make your everyday life a lot more expensive, fast. Inflation was already a headache before this conflict kicked off. The Consumer Price Index, which tracks what we pay for goods and services, was at 2.5% in May 2025, according to the Bureau of Labor Statistics. That's manageable, but barely. Now, with oil prices climbing, Brent crude hit $78 a barrel on June 13th per Reuters. The cost of everything is creeping up. Why? Because oil isn't just fuel. It's baked into the price of almost everything you buy. From the trucks that deliver your Amazon packages to the factories making your phone, higher oil costs ripple through the supply chain. Capital Economics estimates that if oil hits $90 a barrel, U.S. inflation could jump to 3.5% by the end of 2025. That's a 40% increase in the rate of price hikes, and you'll feel it everywhere. Take groceries, for example. The USDA says food prices were already up 1.8% this year before the conflict. Now, with shipping costs rising and farmers paying more for fuel and fertilizer, your weekly grocery bill could climb another 5 to 7%, according to Goldman Sachs. That's an extra $20 or $30 a week for the average family. And it's not just food. Airfares are spiking as jet fuel gets pricier. Delta and United already warned of fare hikes per CNBC. Your electric bill? Up too, since many power plants rely on natural gas, which tracks oil prices. The Energy Information Administration says household energy costs could rise 10% this winter if the conflict drags on. Here's where it gets uglier. Inflation doesn't just make things more expensive, it forces the Federal Reserve to make tough calls. The Fed was planning to cut interest rates later this year to ease borrowing costs, according to the Wall Street Journal. But with inflation rearing its head again, those cuts are on hold. Fed Chair Jerome Powell hinted at this in a June 15th speech, saying, "We're watching geopolitical risks closely. If inflation keeps climbing, the Fed might even raise rates. That means your car loan, your mortgage, your credit card debt, all of it stays expensive or gets worse." The average 30-year mortgage rate was 6.8% last week, per Freddie Mac. If rates tick up to 7.5%, a $300,000 home loan costs an extra $150 a month. That's $1,800 a year gone. And it's not just individuals getting squeezed. Businesses are feeling the pinch too. Higher costs mean they either raise prices or cut jobs to stay afloat. The National Federation of Independent Businesses says 20% of small business owners are already planning layoffs if costs keep rising. That's bad news for the 160 million Americans in the workforce. If you're working a 9 to 5, your job security just got shakier. And if you're looking for work, good luck. Job postings dropped 3% last month, per LinkedIn, as companies brace for uncertainty. So why is this conflict making inflation so hard to control? It's the Middle East's chokehold on energy markets. Iran pumps about 3 million barrels of oil a day, roughly 3% of global supply, per the International Energy Agency. If sanctions or strikes cut that output, prices soar. And Iran's threats to block the Strait of Hormuz, where 20% of the world's oil passes, aren't helping. Even if they don't follow through, the fear alone keeps traders on edge, as Reuters reported on June 14th. Add in the US's role, $3.8 billion in annual aid to Israel, plus emergency funds for missile defense, per the State Department, and you've got a recipe for economic strain. Look, I know this feels heavy. Nobody wants to hear that a war 6,000 miles away could jack up their rent or grocery bill, but ignoring it won't make it go away. In part 3, we'll talk about what this means for your investments and retirement savings, and why the US economy might be more vulnerable than you think. Stick with me. We're peeling back the layers of this crisis so you can see what's coming and how to protect yourself. So, we've seen how this Israel-Iran conflict is jacking up your gas and grocery bills, and how inflation's making everything pricier. But there's another hit coming, and it's aimed right at your financial future. Your savings, your 401k, your retirement fund, maybe the money you're stashing for your kids' college, could get hammered if this crisis drags on. Let's talk about why Wall Street's freaking out, and what it means for your investments. Markets hate uncertainty, and this conflict is pouring it on thick. When Israel hit Iran's nuclear sites on June 13th, 2025, the S&P 500 tanked 1.1% in a single day, per the New York Times. By Monday, June 16th, it clawed back some losses. CNBC reported a 0.5% uptick. But don't let that fool you. Morgan Stanley warns that if this war escalates, we could see a 15% market drop by year-end. That's not just numbers on a screen. If your retirement account's got $100,000 in it, a 15% hit wipes out $15,000. Poof, gone. And for folks nearing retirement, that's a gut punch you can't just shrug off. Why are investors so spooked? It's not just the fighting, it's the ripple effects. Higher oil prices, Brent crude still hovering around $74 a barrel per Reuters, are squeezing industries like airlines and shipping. Delta stock is down 4% since last week, per Yahoo Finance, and FedEx is warning of higher costs. Meanwhile, defense stocks like Lockheed Martin are spiking. But unless your portfolio is heavy on war machines, that's not saving you. Most Americans have their money in broad index funds or mutual funds. And when the market dips, those take the hit. The Vanguard Total Stock Market Index Fund, one of the biggest, lost 1.8% last week alone, per Bloomberg. Then there's the safe haven scramble. When fear kicks in, investors ditch stocks for gold and bonds. Gold's up 5% since the conflict started, hitting $2,700 an ounce per Kitco. That's great if you own gold, but most folks don't. And bonds? Yields on 10-year treasuries jumped to 4.2% on June 16th. Per the Wall Street Journal. Higher yields sound nice, but they make existing bonds less valuable and jack up borrowing costs for everyone. If you're planning to buy a house or refinance, that dream just got pricier. Here's the real worry. The US economy was already wobbly before this mess. The deficit's at $1.9 trillion per the Treasury Department, and now we're funneling more cash to Israel, $3.8 billion a year, plus extra for missile defense, says Al Jazeera. If Iran's oil gets choked off, say 2 million barrels a day, per the International Energy Agency, oil could hit $90, driving inflation higher. That spooks the Fed, kills rate cuts, and tanks markets further. JP Morgan says a prolonged conflict could shave 1% off US GDP in 2026. That's slower growth, fewer jobs, and less money in your pocket. Look, your savings aren't just numbers. They're your security, your plans, your peace of mind. This conflict's putting all that at risk. In part 4, we'll wrap this up with what you can do to protect yourself, from smarter investing to cutting costs. Hang tight. We're almost through this, and I've got your back. We've been through the ringer, skyrocketing oil prices, inflation eating your paycheck, and markets threatening your savings. This Israel-Iran conflict is hitting hard, and it's not slowing down. But here's the good news. You're not helpless. There are steps you can take right now to protect your wallet and your future. Let's wrap this up with some practical moves to weather this storm. First, let's talk budgeting. With grocery and gas prices up, USDA says food costs could rise 7% this year. Track your spending like a hawk. Apps like YNAB or Mint can help you spot where your money's going. Cut back on non-essentials, like that extra streaming subscription, and stock up on staples when prices dip. Cooking at home more? It's cheaper and adds up. If you're driving, combine trips or carpool to save on gas, which is still $3.80 a gallon on average, per AAA. Next, your investments. Markets are shaky. The S&P 500's still volatile, per Bloomberg, so don't panic sell. If you're in it for the long haul, stay diversified. Experts at Vanguard say broad index funds can weather downturns better than single stocks. Got some cash? Consider treasury bonds. They're yielding 4.2%, per the Wall Street Journal, and they're safe. Gold's at $2,700 an ounce, per Kitco, but it's pricey to jump in now. If you're near retirement, talk to a financial advisor. Don't wing it. A Fidelity survey says 60% of Americans regret not planning earlier for market dips. Debt's another trap. With the Fed holding rates high, mortgages at 6.8%, per Freddie Mac. Pay down high-interest credit cards first. The average card rate's 20% per bank rate. Even $1,000 extra paid now saves you hundreds long-term. If you're locked into a low-rate loan, don't refinance yet. Rates might not drop soon, says Reuters. Finally, boost your safety net. The job market's wobbling. LinkedIn says postings are down 3%, so pad your emergency fund. Aim for 3 months' expenses, about $10,000 for the average household, per the Federal Reserve. Side hustles, like freelancing or ride-sharing, can help. Upwork reports a 10% uptick in gig work this month as people brace for uncertainty. This conflict's a wake-up call. Oil could hit $90 a barrel, per Goldman Sachs, and our $1.9 trillion deficit, per the Treasury, isn't helping. But you've got tools. Budget smart, invest steady, tackle debt, and save more. This isn't just about surviving, it's about taking control. The Israel-Iran crisis might be out of your hands, but your financial future isn't. Stay sharp and you'll come out stronger.